This is Sean Hyman from MyWealth.com. I just want to talk to you about today's topic, which is how the pros know that the worst is over. You know, historically, I've seen retail investors get it wrong. They're always late to the ball game, and institutions always beat them, beat their returns and get into bull markets ahead of time. Get out long before retail investors realize they should get out. And I know this is problematic for a lot of the retail investing public. So I want to talk today about what cues, what clues that these guys look at that will help you know the early signs of economic recovery, which will lead to stock recovery, which will lead to foreign currency recovery, and also into a new downtrend in the dollar. So let's get started.
Be sure to check out the written blog at www.mywealth.com/blog. Today's title is How Pros Know That the Worst is Over. Retail investors get lost by following analysts, economists, and the financial news media. And many do this, so if this has been you in the past, don't get condemned here, but let's learn something from it. These are all futile if you're looking for the prime time to start accumulating new stock and currency positions. So what do the pros use then? They look to commodity prices. Now, why do they do this? Because companies have to buy commodities first in order to build the products that they will sell, such as houses, cars, plumbing, wiring, computers, things of that sort. Just copper alone is used in pretty much every one of those instances. So these companies have to buy these raw commodities and put them into whatever form they need to make their products, then sell them to the public, to retail public and to corporate America as well. So recently, commodities overall have broken their downtrends, and many have even started new uptrends too. So this shows that the demand is returning, but no one seems to have picked up on it yet. Institutional investors will have their positions in long before the investing public realize it, and before they realize really that they should even be buyers. Then once the financial reports start finally coming out that show that the recovery of the economy is underway, the best prices in stocks and foreign currencies are long gone. Retail investors don't realize this, however, they just end up pushing up the institutional positions and making these institutions look like geniuses. One great example of this is the recovery in oil prices and the recovery of the euro versus the dollar around the same time. See the chart on the next slide. You'll see euro dollar on your left, so that's the euro traded versus the dollar. So when the euro goes down, the dollar is going up, and vice versa is true as well. And then on the right-hand side, you have oil. Now notice they tend to trade in tandem over time. This is not tick for tick or day by day, but over months and a year or two, you see these trend and head in the same direction. Everybody was really realizing, because the news media made it very evident when oil crashed from 147 or so down into the 30s. However, they're not nearly as quick to talk about the recent increase, the breaking of the downtrend in oil, the breaking of the sideways trend in oil, and the new fresh start of the beginnings of an uptrend in oil. And the euro and oil tend to travel in the same direction, and they both tend to travel in the same direction versus the dollar. So you can almost think about these like on a teeter-totter. The euro and the oil on one side of the teeter-totter, and the U.S. dollar on the other side. And so what this tells us is that the U.S. dollar in the coming months to year is getting ready to head downward, more than likely, as oil and the euro both recover. So this is one way that you can take advantage of what's to come by looking at oil prices or prices of gas at the pump, and that tells you a lot about where the euro versus the dollar is going. So oil goes up because of increased demand, yet most won't pick up this for months, minimally. By that time, the best pricing has gone out of both stocks and currencies, as we said before. And in the currency course, you'll learn about simple correlations like this, that will help you to put you way ahead of the pack in both your stock and your currency investing. I want to make that clear, because the currency investing course is going to teach you about big global macro trends that even before you invest in currencies, it's going to help you in your stock investing as well. So it's going to help you in both. So don't wait. Get in a course. Get educated at www.mywealth.com.
Hope you enjoyed that today. I believe you found a new fact, something you can really sink your teeth into. It's going to help you a lot. But keep in mind, these are just little glimmers, little tastes of really the whole enchilada of really what we have to offer. And for a $20 course in our currency investing Forex course, you can get enrolled online today and learn so much more that really is not only going to just help your currency investing and let you learn about macroeconomic trends, but it's also going to tip you off and help you to your stock investing as well. Just like the things that we learned today, the things that are helping these foreign currencies are also going to help stock portfolios as well. So while you may not think that you know that much about currencies, you probably have stocks through a 401k, IRA, stock options, something of that sort. So I would encourage you to do this for your own currency knowledge and also for your stock portfolios. And you can learn more about this at www.mywealth.com. Click on the courses tab and get started today. Thanks so much.